So as I mentioned in the last video, property insurance prices are being driven by a few more factors that are complicating things. And in the interest of keeping things brief, splitting this up into a few different videos. So, property insurance part 1. First, we have data from the National Association of Home Builders showing that the cost of building a single-family home has increased from a national average of $114 per square foot in 2019 to $153 per foot by the end of 2022. That alone is a 34% increase, which explains a lot. But there's more. If it were just prices going up, just like with the auto insurance world, the companies would simply adjust prices and call it a day. But that's not it. There's more to it. We have what's called a hard market, and it is a very hard market. It's the hardest I've personally seen in the 22 years I've been in the industry. A hard market is when competition is sparse. Competition keeps prices low. Companies started to very slowly pull back on their competitive stances several years ago. By the end of 2022 and into early 2023, that went into fast forward. While there are some companies still writing new business, some are offering prices at very high rates that are simply unattractive, and they know it. They aren't getting any new policies, and they're okay with that. Then there are others who are simply saying no to new business altogether. Why would an insurance company, why would any company for that matter, turn down new business? Well, it hasn't been profitable. Most property insurance companies work on very thin margins to begin with, and when construction prices started rising in 2021, the trend of shrinking profits turned into widespread losses. Then 2022 happened, and those losses nearly quadrupled. The cause of this was multifaceted. It was both inflation and an increase in the frequency of catastrophe events. Catastrophe events are when there's widespread property damage across an area, not just a few sparse claims here and there. Now, you can blame that on whatever you want, but it is the trend that we're in. Catastrophe causes enormous financial losses. They can be thought of as the insurance world's equivalent to a bank run. Basically, there's too much money going out at one time, and the system has the potential to destabilize. Retail insurance companies keep a certain amount of money on hand in what's called reserves to be able to cover a fair amount of losses, but not 100%. So when catastrophes happen, they rely on something called reinsurance. This is insurance that the insurance company carries for catastrophe events. It's purchased from reinsurance companies and helps keep the price you pay lower than it would be if your insurance company had to keep enough cash to cover 100% of its potential losses. Now, I'll cut this video here and get into the details of reinsurance in the next video. See you there.